three growth stocks we're going to cover in this video have outperformed the S&P 500 year to date and have rising profit margins. Let's get into it. The first stock on this list is Deckers Outdoor, ticker symbol DECK. This athletic apparel company has UGG, Hoka, and a few other brands under its umbrella, but those are the two main ones. The stock is up by more than 30% year to date and has gained more than 500% over the past 5 years. It is a recent member of the S&P 500. The company recently reported earnings for the first quarter of fiscal 2025, which featured 22% year-over-year revenue growth and 82% year-over-year net income growth. Hoka was the largest growing segment of Deckers Outdoors results, which was up by 29.7% year-over-year. Hoka makes up more than half of the total sales that Deckers Outdoor makes. So as Hoka continues to gain market share and continues to support an elevated revenue growth compared to other segments within the Deckers Outdoor umbrella, we should see accelerating revenue growth in the future, and rising profit margins certainly help the bullish narrative. The stock trades at a 29 PE ratio. Our next stock on this list is American Express, ticker symbol AXP. This stock is also up at more than 30% year to date, allowing it to outperform the S&P 500. It has roughly doubled over the past 5 years. More than 3 million new card acquisitions were one of the highlights in the company's second quarter earnings results. We also saw revenue go up by 9% year over year, while net income was up by 39% year over year. The rising profit margins continue to be a theme for this company. American Express's profit margins were above 20% in this quarter. Interestingly, the company only has an 18.5 PE ratio, which puts it much lower than other credit card companies that are reporting similar financial results. Visa and MasterCard, you regularly see PE ratios above 30 for those companies, which makes American Express look like quite the bargain. American Express should continue to gain market share since a lot of the new incoming cardholders are millennials and Gen Z consumers. So it is winning younger markets, which should help it to establish its dominance and maintain its presence in the credit and debit card industry. American Express also has a dividend yield above 1%, and they are really good about growing the dividend. The company did a 17% dividend hike earlier this year, and it has regularly maintained a double-digit dividend growth rate for several years, making this a dividend growth stock to consider. The final stock on this list is Alphabet, ticker symbol GOOG or GOOGL if you want to be able to vote on company matters. The company reported Q2 results which featured 14% year-over-year revenue growth and 29% year-over-year net income growth. Alphabet has its advertising segment, which has been a top producer for many years. A lot of people go on Google to search for information. A lot of people go on YouTube, you're here right now, to watch videos and see ads from time to time. But Google Cloud is becoming a bigger segment of revenue. It makes up more than 10% of total revenue, and it's growing at a faster pace than the advertising segment. In the second quarter, Google Cloud revenue was up by 29% year over year. Artificial intelligence tailwinds should result in elevated revenue growth in future quarters because a lot of AI apps, they need cloud service providers to host their apps. And Google is one of the leading players in the industry. It's got 11% market share in the cloud computing industry, only behind Amazon and Microsoft. So cloud can help Google gain more momentum, and the stock has already done quite well with its year-to-date gains and its 5-year gains. As a Magnificent Seven stock, it's got a heavy weight on the S&P 500 and the NASDAQ as a whole. So price fluctuations in Google and the other Magnificent Seven stocks will have a big impact on the total index returns. It's been good so far this year in terms of Alphabet's role with those indices. Another advantage with Google stock is the valuation, only trading at a 25 PE ratio. Despite double-digit year-over-year revenue growth and rising profit margins, the valuation makes it look like a bargain relative to other companies that are growing at a similar pace. Alphabet also recently started its dividend and looks like it's going to be a dividend growth stock. I wouldn't be shocked to see the company maintain a double-digit dividend growth rate for many years in a move that would reward long-term investors. Those are my 3 growth stocks. Let me know which ones you are looking at and make sure you subscribe for more videos just like this one.